Hello, this is the third in my series of trading for beginners who have never traded before. And like I've said in other videos, if you you have been trading for a while, you might find some of the information useful. But this is basically designed for someone who's never traded before, and I get a lot of questions. Well, how do you get started? And this is my series that I'm doing on how to get started in trading. So in the last one, I talked to you about practice accounts and where to get them and how they work and so on like that. So now we get down to trading. So here's what you do. You've got your practice account and you got $50,000 in it, which is standard for just about every trading account that you can get. You get a free demo account. Sorry. But with that $50 account, you trade. Now you can trade different sizes. You can trade the standard lot. You can trade the mini lot. You can trade the micro lot, and so on like that. But because you're beginning, I recommend that you trade the micro lot. And with trading the micro lot, you will definitely lose money on your account. Like I've said before, you could blow out your practice account, but the good thing about that is you simply reset your practice account and you're back up to the $50,000 and you keep going. And you can try different things. You want to try trading big lots, a standard lot or whatever, you can go ahead and do that. If you see some wild thing that you saw on the internet and you want to try it, and they promise you're going to get rich overnight by using their system and so on like that, you can go ahead and try it on a practice account, and it doesn't matter. You try it, you blow out your account, you can say, yeah, okay, that doesn't work for me, and you can move right on. So here's what you do. You trade your $50,000 account, and after you've been trading it a while, if you manage to double the account, so you went from $50,000 account and now you've made $100,000, now you're ready to open a real cash account. And like I've said before, there's FXCM is the one I use. There's also forex.com. There's hundreds of companies that will allow you to trade real currency, and it depends. Some of them, it depends on their licensing. If you're trading in any country, you have to be licensed. So like if I'm trading in Canada, some trading outfits don't pay for a Canadian license, so you can't use them. So they might look good, but they don't trade there. Same as the US. They might not want to trade in the US market because it's too overcrowded or something. So they won't buy a license there. So it all depends on the licensing, but you can get going. And like I said, in Canada, you need a $5,000 account to start with. And once you've opened that account, even if it goes below $5,000, you're good. They still keep you there. Okay, so how do you trade the live account now? Well, what you do with the live account is you trade one micro lot, and that's the 10-cent one that you get 10 cents per pip. So you trade that, and so each trade on a $5,000 account, you only trade one micro lot. Now you've got 28 currency pairs that you can trade. You can trade one micro lot on all 28 currency pairs and have them all going at the same time. But the rule is it's one micro lot per $5,000. Now you trade and you get your account up to $10,000, so you've doubled your account. Now you're able to go to two micro lots. So you're able to trade two micro lots, and you can trade them across all 28 currency pairs, like I said. So you're trading two micro lots, and that's basic. The size of your account has gone up, so the size of your trades can go up. And that's the good thing about forex, because it doesn't matter whether you're trading one micro lot, two micro lots, 10, which is a mini lot, or whether you're trading a standard lot, which is 100 microlots. Sorry, it trades the same way. So whatever the chart of the currency pair is, that's basically, it doesn't matter. They trade identically for what size. If you're trading 10 standard lots or 100 standard lots, it all trades the same way. So, your stop loss, your gains, so on like that, it's all based on that. So that's another benefit you have to Forex as opposed to the stock market, where people normally start out with. So with your 50 or your $5,000 account, you play with it, and let's say you get it up to $25,000. Well, then you're trading 5 microlots, and because that's your standard of 1 microlot per $5,000, you get to 50,000, you trade 10 microlots, and of course it works in reverse. You go from $50,000 down to $25,000. Well, you go from 10 micro lots down to 5 microlots, and so on. You go down, you lose money, and you go down to $5,000. You go back to 1 microlot. So basically, as long as you're keeping that standard, it keeps you in the market a long time. Where if you try to hit home runs every day, if you don't hit the home run, you also lose a large chunk of money. So that is one of the drawbacks to trading large sums. Now, in trading that, and you got those trading rules, there's a few indicators that I use, and they're pretty standard in the industry. Wherever you go, you'll see them. And there's the 10 period simple moving average, and that basically accounts back the last 10 candles that you have on your account, whether or not it's 1 minute, a 5 minute, an hourly, daily, weekly, whatever your chart is, it counts 10 of them. So that gives you an average of the 10. The next one I use is the 20 period simple moving average, which is basically the same as a 10, but it's larger, so it takes the average over a longer period of time, so it moves up and down slower. Another one that's quite common is the 50 period moving average, and you'll hear it referenced in different things all the time. The 50 period moving average is basically 2.5 months of trading, so that's a long period of time. The other one is the 100 period moving average, which again is a lot longer, and that's basically if you're on a daily chart, that's 5 months of trading. So it takes the average over the period of 100 of the periods and gives you a line, and of course that moves slower than the thing. So the larger the number, the slower it moves, and the slower the moves gives you a longer period average. And one of the big famous ones is the 200 period moving average, and that's referred to by many people as the granddaddy of moving averages. So basically, if you're on a daily chart, that would be 1 year's trading, so it's the average of the price that's traded for 1 year. So all the ups and downs and so on like that is what you have. Another one I often use is what's called the ADX, which is the average directional index, and that basically shows you the direction that the market is going. Another one is the stochastic, and the stochastic indicator is, once again, it tells you whether or not there's a trend there. So is the trend going up, or is the trend going down, or is the trend going sideways? Another one that is very common is the MACD, and that stands for Moving Average Convergence Divergence. So basically you've got two lines, and when one crosses up, it's a buy signal. When it crosses down, it's a sell signal. So this is a very standard in the industry. There's another very common one, and that people will talk about. It's the Bollinger Bands, and I don't personally use the Bollinger Bands. It takes a lot of study to learn them. They're, sort of complicated, but I can tell you when I was beginning the Bollinger Bands, I would buy a stock, and no sooner would I buy the stock, the price of the stock would fall. And or I'd be in a stock and the price would be going down, and I'd decide to sell it. And no sooner did I sell the stock that the price would turn around and go back up again. And this is very frustrating for traders. It happens more than people would like to believe. And, it gets very frustrating. You get very angry and so on like that. And one of my friends who was also in trading, and I was complaining to him about that, he said, well, don't you check the monthly Bollinger Bands? And I says, no, why? And he says, well, the mutual fund companies, they don't sit there and stare at their charts, and decide, every few minutes when to buy and sell a stock. They're basically long-term buy and hold investments. And so what they do is they sit there, and when the price hits the monthly Bollinger Band line, the top of it, they sell. It doesn't matter what it is, and so on like that. So the price would go down because they would be selling, probably millions of dollars worth of these shares. Then at the same time, when it hits the bottom of the Bollinger Bands, doesn't matter what the company is doing, they would simply buy back into it. So they're buying low and selling high, and they just do that back and forth, and with that, their investment goes up. And so it doesn't matter. I would research this, and I'd say, I want to buy this stock. The company's doing really well. Bang! I'd notice the Bollinger Band would be at the top of the thing, so I wouldn't buy it. And sure enough, the next day or a day or two after, the price of the stock would drop. And it wouldn't necessarily be significant, but it would drop enough that, it would hurt you if you were in it. And vice versa. When I'd be looking at selling an investment that I had, I'd look at the monthly Bollinger Band, and I'd see, oh, it's just about to hit that. So I'd wait for it to hit the monthly Bollinger Band, and like clockwork, it would go back up again. But to actually trade the Bollinger Bands, like I said, it's the way the mutual funds do it, is very slow and clunky. But the learning of Bollinger Bands is quite a complex thing. This does this, and this does this, and so on like that. So that's where you go with the Bollinger Bands. Now, one of the things with trading is everybody's out there trying to sell you a trading program. I can tell you right now, as a beginner, I've bought into these trading programs, and some are good, some are bad. But basically, everything you can want to learn on trading is out on YouTube, and it's free of charge. It doesn't matter whether it's stocks, commodities, or whether it's Forex, even cryptocurrency. They're all the same. The way the charts read, the moving average, everything is identical. Because it's humans that are trading it. It's definitely a situation that people, their fear and greed is the same. So that's a wrap up of this trading lesson for trading for beginners who have never traded before. And we'll get into the next one, and the links will be down below. So thank you very much. If you found value in this, please click like and subscribe. I'd really appreciate that. I think that sort of tells me that I'm on the right road, and I'm helping people out. And so thank you very much.